Elon Musk's $29 billion payday. What's behind Tesla's massive CEO package? Elon Musk's latest pay package from Tesla is stirring up big conversations, and with good reason. Topping out around $29 billion, this compensation deal arrives after a series of legal battles and shareholder disputes, making it one of the most talked about executive rewards in recent history. But here's where it gets controversial. Several months ago, a Delaware court rejected Musk's 2018 performance-based award for the second time following a shareholder lawsuit, and Musk is now fighting to overturn that decision in an ongoing appeal. Tesla addressed this situation in a recent letter to shareholders, emphasizing that Musk has not received significant compensation for 8 years, and that the company's legal team is still working to restore the 2018 payout, though no clear timeline for resolution exists yet. The proposed package would grant Musk 96 million Tesla shares, each valued at just over $300, with Musk required to pay $23.34 per share, matching the original terms of his 2018 award. Board members Robin Denholm and Kathleen Wilson-Thompson stated, "Despite these legal challenges, Elon's unparalleled leadership and vision have driven the extraordinary growth needed to achieve all the milestones of the 2018 CEO Performance Award." They highlighted that this growth has translated into immense value for Tesla and its shareholders. It's worth noting that Musk doesn't receive a traditional cash salary or bonuses. Instead, his wealth primarily stems from stock options that allow him to buy Tesla shares at a fraction of their current market price, an arrangement that has made Musk one of the richest people globally. Currently, he owns about 13% of Tesla. However, Musk's recent political involvement has sparked considerable criticism among shareholders. More than a year ago, and again earlier this year, Musk invested significant time and money backing Republican candidates, which some argue has backfired on Tesla. Political protests at Tesla dealerships increased, and the company's sales have shown sharp declines, partly due to political opposition and legislative changes. President Trump's policies also cut Tesla's access to tax incentives and regulatory credits, key revenue drivers for the automaker. Tesla's stock, TSLA, has dropped roughly 25% this year, though it experienced a modest 3% increase in pre-market trading following the news of Musk's pay package. Recently, Musk announced his intention to return to a full-time role at Tesla, addressing shareholder concerns about his engagement, especially given his prior track record of success. In addition, Musk has shifted Tesla's strategic focus toward artificial intelligence and robotics, aiming to transition the company's identity from being solely an electric vehicle maker to a leader in new technologies. Tesla is also working on launching its highly anticipated Robotaxi service, although it's currently operating on a much smaller scale than Musk originally envisioned. As the company explores these new frontiers, the question remains: will Musk's bold new vision steer Tesla back into growth, or is the company heading toward a challenging period of transition and uncertainty? What do you think? Does Musk's bold pay structure align with his innovation-driven leadership, or is it a sign of trouble ahead? Share your thoughts. This debate is far from over. Tesla board approves $23.7 billion stock award for Elon Musk. Is it fair for one person to receive a stock award worth nearly $24 billion? That's the question swirling around Tesla's latest move, a decision that's already igniting heated debates across the business world. In a bold attempt to keep Elon Musk's attention fixed on Tesla, the company's board has just approved a staggering stock grant for its CEO. The package, valued at an eye-popping $23.7 billion, translates to 96 million new shares, one of the largest stock awards ever given to a single executive. The goal? To ensure Musk remains at the helm of the electric vehicle giant for at least the next 2 years, especially as the company faces mounting challenges in a fiercely competitive market. But here's where it gets controversial. Musk hasn't received any compensation from Tesla since a Delaware court threw out his previous $50 billion pay package earlier in 2024. This new award is essentially a high-stakes bet by Tesla's board, designed to keep Musk motivated and focused on steering the company through turbulent times. However, there's a catch. Musk can only claim this new stock award if after Elon Musk's $29 billion pay package, the highest in history, explained. In the world of corporate compensation, few stories are as polarizing or as jaw-dropping as Elon Musk's latest pay package. At a staggering $29 billion, it's not just the largest CEO payout in history. It's also a lightning rod for debate about fairness, accountability, and the future of executive pay. And here's where things get even more controversial. Musk doesn't even need to hit specific performance targets to collect this windfall. All he has to do is stick around at Tesla for the next 2 years, either as CEO or in another senior leadership role. Sounds simple, right? But let's dive deeper into what this means for Tesla, its shareholders, and the broader business landscape. The Tesla board, led by Chair Robin Denholm and Director Kathleen Wilson-Thompson, has framed this decision as a necessary move to retain Musk's unparalleled talent. In a letter to shareholders, they emphasize the escalating war for AI talent, pointing to recent trends like multi-billion-dollar acquisitions of tech firms and eye-watering compensation packages for individual AI engineers. Even within this elite group, they argue, no one compares to Musk. To ensure his continued focus on Tesla's ambitions in artificial intelligence, robotics, and autonomous vehicles, the board insists that this nearly $30 billion award is not only justified but essential. So, how does this new deal differ from Musk's previous compensation structure? Unlike his earlier plan, which required him to meet stringent shareholder value milestones to unlock rewards, this arrangement is far less demanding. As long as Musk remains with Tesla for the specified period and holds on to his shares until 2030, he'll receive the full benefit. This will increase his ownership stake from approximately 13% to 15%, further aligning his interests with those of the company, or so the theory goes. But here's the part most people miss. The technical details of the award reveal some eyebrow-raising elements. While the payout technically comes in the form of restricted stock, Musk must pay $23.34 per share to exercise the options, a figure identical to his 2018 grant. With Tesla's stock currently trading above $300 per share, this effectively gives Musk a built-in profit of roughly $280 per share. Compensation experts have dubbed these types of grants fog the mirror awards, suggesting that all Musk needs to do is show up and breathe to qualify. Larry Cunningham, director of the University of Delaware's Weinberg Center for Corporate Governance, summed it up succinctly. A deep-in-the-money stock option grant, awarded solely for retention. No elaborate performance metrics, no complex hurdles, just a straightforward incentive to keep Musk tethered to Tesla during a critical phase. And yet, there's a catch. The actual size of Musk's payout hinges on the outcome of ongoing litigation tied to his original 2018 compensation package, which was valued at $56 billion. If courts ultimately reject that earlier award of 303 million stock options, Musk stands to keep the new 96 million shares, worth about $29 billion at today's prices. However, if any portion of the original grant is reinstated, the new award will shrink proportionally. Eric Hoffman of Farian Advisors described this as a floor and ceiling mechanism designed to prevent double dipping. This legal tightrope walk highlights the unprecedented nature of Tesla's approach to executive compensation. There's no playbook for this. Hoffman explained, after all, the board's first attempt at crafting a mega grant was overturned by a judge. Their second try gained shareholder approval, but faced renewed legal challenges. Now, Tesla finds itself navigating uncharted waters once again. Adding another layer of complexity, Tesla recently relocated its incorporation from Delaware to Texas, a strategic maneuver aimed at shielding Musk's compensation from potential lawsuits. Under Texas law, shareholders wishing to challenge the award would need to own at least 3% of Tesla's stock, a threshold valued at over $3 billion. Columbia law professor John Coffey, meanwhile, reactions among Tesla investors remain divided. On one side, there's a passionate base of retail investors who view Musk as indispensable to Tesla's success and have voted overwhelmingly in favor of his compensation plans, not once, but twice. On the other hand, institutional investors managing pension funds have expressed outrage. New York City Comptroller Brad Lander called the $29 billion package obscene, accusing the board of prioritizing Musk's enrichment over investor interests. Similarly, Illinois State Treasurer Michael Frerichs criticized the board for neglecting its fiduciary duty, especially in light of Tesla's declining stock price and sluggish sales figures. Even groups representing major shareholders like SOC Investment Group have voiced concerns. In a statement, SOC wrote that the board's own admission that even an additional $24 billion in equity might not guarantee Musk's full commitment is deeply troubling. They argue that Tesla's leadership should be laser-focused on reversing the company's recent struggles, rather than doling out extravagant payouts. So, where does this leave us? Is this bold gamble by Tesla's board a masterstroke to secure the world's most visionary leader, or a reckless disregard for shareholder value? As the legal battles unfold and Tesla charts its path forward, one thing is clear: Musk's compensation saga is far from over. What do you think? Should companies prioritize retaining superstar CEOs at any cost? Or is it time to rethink the rules of executive pay? Share your thoughts in the comments below.